And joining me now is Lwazi Matakane from Nedbank Private Wealth to give us his take on the market's activity. Lwazi, thanks so much for your time this afternoon. So markets pretty much back in the red. What's fueling the negative sentiment we are seeing today, and why the sudden turn? I mean, yesterday we saw U.S. markets hitting record highs, both the S&P and the Nasdaq. Here at home, the JSE all share was edging closer to that 100,000 point mark. But here we are today, markets pulling back in the red. Anything to worry about, or is it just some profit taking?
Yeah, afternoon, darling, and afternoon to your viewers. I think you've touched on what's happening locally. So yesterday we had a good run on the back of commodity prices, and obviously that was at the back of a weaker US dollar. And now we're seeing some profit taking coming into the fore in the local market and then dragging the local bourse down. So the resources 10 you mentioned, the precious and metals mining index is also down 2%, which is affecting our local market. But I mean, if you look at some of these resources stocks that are linked to iron ore, so the Kumbas and the Exaras of this world, they're doing much better today. They're faring better than the rest of the commodity complex. If you're looking at iron ore futures in the Asia Pacific markets, they are doing, the futures are up. They were up this morning in Asian trade, and that's on the back of $170 billion of infrastructure development that's been announced in China. So it depends where you look, but globally, obviously, again, you know, there's uncertainty, but we've seen something peculiar in global markets where volatility has been sanguine. Hasn't been much volatility around Trump and policies and everything else, and markets are edging up slowly, but the breadth in US capital markets particular is actually slowing down. So you're getting a concentration again of stocks that are leading those markets higher.
Ah, okay, I see. Now, while tensions between the US and China have simmered, tensions between Washington and Brussels are brewing as, you know, the US and EU struggle to seal a trade deal. Now, reports are suggesting that the EU is mulling reciprocal measures as the US threatens the EU with a 30% tariff. What's your reading of the trade negotiations as a whole and where we're at, considering that we're getting closer and closer to that 1st of August deadline, and it doesn't seem like, you know, any other deals are being sealed. The question mark still hangs on the deal with Japan, the deal with India as well.
Yeah, look, I mean, we're hearing rumblings out of the Eurozone where an anti-coercive incentive is being mulled against a third-party force that's obviously coercing economic progress within these countries. So the reciprocation of retaliatory tariffs is on the cards again. You never know with the U.S. president. One day he's warm and fuzzy to everyone else, and the next day he's calling you out and wants you to do as you know he states. So there's a lot of policy uncertainty coming out of the U.S. because of this, you know, fractured way of introducing policy into the market, and everyone else is now not so confident whether these deals will take place. I think the market had penciled in the baseline 10%, but now we are seeing obviously everything that's coming out of the White House with this 30% tariffs on the EU, 30% tariffs on neighbors like Mexico and ourselves. And everyone's worried that we're not going to see the baseline 10%. We're actually going to see higher numbers coming to the fore if there's no deals being made.
And talking about those higher numbers, earlier this month, he did threaten the pharmaceutical sector with tariffs of up to 100%. Now we're seeing, you know, some of those pharma players making moves to try and mitigate those risks. AstraZeneca, the latest of the bunch, saying that it'll be boosting its U.S. manufacturing capabilities, planning to invest $50 billion there. What do you make of that move? And do you think, you know, other players, European players in particular, will follow suit?
So the real question is, will these investments actually take place? Because it takes time for the capex to actually roll out. It's not going to happen in a year or possibly during his term. It's going to take time for this to actually materialize. So the signaling by these companies in order to avoid the tariff situation is a good one on their part, where they signal that they're willing to invest in the U.S. and then hopefully circumvent or get some deal on the table where they can actually circumvent some of these tariff numbers. But the truth is, the capex is not going to, the plants are not going to start being operational overnight. That's going to take
Yeah.
time, and we may not even see it during the president's term, depending on how the rollout takes place.
That's so interesting because you're right. They said it would be up until 2030, I think it is, and that
Yeah,
might not even take place anytime soon in terms
yeah.
of those capabilities being in the US at the moment. Let's bring it back home with Sasol saying it's making progress with some of the strategic priorities that it announced at its Capital Markets Day earlier this year. The group further saying it expects to meet most of its financial guidance for the 2025 year. How are markets reading this? I see that the share price is down. I think the last time I checked, it was down close to 4%. Is it on the back of the update or general downbeat sentiment across the board here at home?
Yeah, it could be general downbeat sentiment, and obviously pulling back from the 6% gain that we saw yesterday. But Sasol is largely a turnaround story. I mean, we can see management efforts trying to change the feedstock transition by purchasing higher coal. Therefore, you have their own coal mining operations not producing the numbers. So you've got lower coal production from themselves. Chemical sales volumes and revenues are down. And apart from the narrowing of earnings, or the narrowing of losses from earnings from prior periods, I don't think there's much in that statement that will enthuse the market.
Yeah.
We're just seeing the ongoing efforts to improve a number of things and closing down a number of plants that actually produce phenol derivatives, again on the back of, we call it, environmental concerns. It's a turnaround story. It's still ongoing, and we're still yet to see the positive results, but we are seeing the signals as to the trajectory of the turnaround itself.
All right, let's hit pause on the conversation before we move on to your stock pick. Let's take a moment to touch on what your industry peers find interesting.
What we saw was Coronation came out with their latest AUM update, and in the last quarter up to the end of June, their assets under management went up 9%. So that gives you an idea of the underlying performance that they're seeing as a result of exposure to some of these shares. Naspers Process also doing incredibly well. So, and that will definitely feed through to the bottom line in earnings. A lot of the revenue is obviously driven by the AUM base, and as that's growing, the earnings will grow quite nicely. So it's sort of a leverage play on the JSE. The share price is cheap, sub 10p, with a very high dividend yield. It's been 10-11%. The share has moved up a little bit since that AUM update, but I think it still has a lot of potential. We're quite bullish overall, still on the JSE, and some momentum continuing there. And this is a nice leverage way to play it. If they do perform well, they're also going to get some performance fees. That'll be a kicker. I think that's just sort of extra kicker, but without that, it's still an attractive investment at these levels.
In the background of possibly lower interest rates and inflation, your consumer might be getting some relief. If you take a look at Shoprite's share price is exactly the same as it was 5 years ago, plus minus. Considering their consistent volume growth, their consistent margin growth, basically the quality of the management, and at current valuations, at least a 15% upside as far as I'm concerned, as long as that whole sector keeps on benefiting, as I've said, from more benign economic circumstances and with limited downside. So technically it doesn't look great, but it looks good enough if you are looking for an entry into your consumer side of things. I don't think Shoprite, as the leading company in that sector, is at a terrible price to actually start buying some.
So local counters, Coronation and Shoprite, stock picks for some of our analysts. What are your analysis on those counters in particular?
Yeah, look, I mean, holding asset managers is obviously a leverage play on thematic investing. Certainly our market has done very well. The top 40 is up at least 20%. The oil share is up 18%. So if you are looking to play South Africa on leverage play again, that's a good household name to hold. I mean, AUM growth on performance provides a good impetus for investment flows into asset managers, which certainly affects revenue from fee income. So there's also an upside there for Coronation as a company itself. So it's a good household stock to hold for clients. one I wouldn't be averse to. With respect to ShopRite, look, it's a behemoth. It's the biggest the biggest retailer in South Africa. It's in every corner of the country. It's got its market segmentation very well with respect to the Checkers brand and ShopRite being in the lower segment. And really, I mean, you can't really fault the operations of the company with management. They've done well to deliver year in and year out on top line, on bottom line. And it's a company that you would like to just put in the back of the drawer, hold it for as long as possible, and it will churn out those earnings for you. So it's a blue chip stock. We like it. It's one we keep for our clients as well.
So it's one that you like, but not your stock pick. Is local lekker for you? Are you going for something in the JSC?
No, so I'm changing jurisdiction now. I want to actually look at MSCI India or the Cetrix feeder fund into the JSC, where you can get Indian exposure locally from that. Look, we know India is one of the fastest growing economies so far. If you look at, I mean, OECD or IMF forecasts, they're forecasting growth of about 6% or so for 2025. It's one of those markets that are relatively under the radar with respect to well-known EMs. If you're looking at Asia-Pacific markets, so China is probably the most talked about EM market. Within Asia-Pacific, you got like China, Japan, and all these other countries that are most topical. There's other things that are in play within the Indian space. I mean, there's potential benefits from for the Indian defense sector from this European arms race. And much like China, when China was growing above average global growth, they saw portfolio flows. We are seeing the same portfolio flow effect going into India with respect to indexation. When these benchmark indices start upweighting a jurisdiction, those flows start coming in and coming through. So that affects the performance on local capital markets in that jurisdiction. So yeah, just some exposure into wider Asia and a fast-growing economy in that sense.
All right, let's leave it there. Thanks so much for your time and sharing those insights. That was Lwazi Matakane from Nedbank Private Wealth.